Oh, here we are live. Hello and good evening, everyone. Thank you for joining us this evening. Welcome to Toronto Public Library's online program, Planning for Retirement on a Low Income. My name is Laura Ariza, and I am joined on screen with Andrea Geddes Poole. And Andrea is a member of the Toronto Library Board and will introduce our session. First of all, though, I would like to acknowledge that Toronto Public Library is situated on Indigenous land and Dish with One Spoon territory. This is the traditional territory of the Haudenosaunee Confederacy, the Wendat, and the Mississaugas of the Credit First Nation. We gratefully acknowledge these Indigenous nations for their guardianship of this land. So very quickly, I know we have a lot of information to get through, but I do want to draw your attention to the chat box. And thanks to all of you who are saying hello in the chat box right now. If you would scroll up in that chat to the very top of it, you'll see that I have posted Toronto Public Library social media policies and rules of conduct. That's simply how we are monitoring chat discussions that take place. You are invited to enter your questions in this chat and they will be answered throughout the session, but I'll also let you know that we will have a formal Q&A session at the end of this whole session as well. And I will also let you know, because I know you're going to ask, the background materials, the booklet that's so wonderful. There's a course that's available for financial advisors. All of that information is going to be shared to all registrants of this evening's event. So relax, take your time and enjoy this session. There's a lot to take in, and simply know that the supporting material is there for your referral, and it will come your way. So now, let me hand things over to Andrea, who is going to deliver our introductory remarks. And thank you very much, Andrea, for joining us this evening.
Thank you very much, Laura. First of all, hello, everybody, and welcome. Thank you for joining today's program, which is Planning for Retirement on a Low Income. My name is Andrea Geddes Poole, and I have the privilege and honor of serving as a member of the board of the Toronto Public Library. And I am pleased to introduce tonight's program. And tonight, you will be hearing about how income security programs work in retirement, particularly when you anticipate collecting the Guaranteed Income Supplement, the GIS, and how additional sources of income can affect those entitlements. I would like particularly to introduce our presenter, John Stapleton, who is a well-known social policy advocate, principal of Open Policy Ontario Consultancy, and extensively published in both local and national media. And his sessions always attract great interest and high attendance, as we can see from our numbers tonight. Now, joining John in tonight's session is Alexandra McQueen. And Alexandra is nationally recognized as an expert in financial planning, retirement, pensions, and is a highly respected journalist and author. And Alexandra will be answering questions in the chat box on your right throughout the workshop, and will join John on stage for the final Q&A. So please join me in welcoming both of our leaders, and let's hand it over to John to get things underway.
Thanks very much, Andrea. What I'm going to try to do now, and that is to put the presentation on screen. And so it didn't go up, so so just wait, everybody here. I'm going to make sure that that we have the PowerPoint and that we're able to put it up. So I have just gone through the manual, which says set up the slideshow, and that seems to be in good shape. And then I'm going to start it from the beginning slide, which is what I'm supposed to do. Then I have to do something that's called windowing it, because if I don't window it, I can't go back into the thing that tells me where to put this. Aha! And it came up just like magic. So there, I am now going to share it. And then I am going to do something called unwindowing if I can.
Fantastic, John. It is
Ready?
nice and clear for me, and I hope for everyone else.
Not quite. I just have a couple more things to do. There, now, how's that? Does that look good, Laura?
It looks great.
Okay, here we are at the beginning, and I'm about to motor for about an hour and 45 minutes for those. And I'm going to ask Laura, there's some noise on her machine, so I'm going to ask her to turn that off. And it's off, and now we're going to motor forward. And hopefully we are going to get this on a YouTube with the proper accommodations, and we'll let you know. We'll be able to let you know when that's going to take place. Okay, so let's get right into it and dive in deep. And let's first say for new in 2022, there is going to be a higher old age security. Laura, there's still noise in the background at this point for me, so I'm going to just ask them. Okay, that's good. Higher OAS for 75 plus people. So that means if you reach 75 years of age, you're going to get a 10% increment. And by July 2022, depending on what happens with inflation, but if it stays the way that it is, you're going to get a single old age security payment of over $700 per month. So it's going to, right now we're somewhere around 650, and we're or 630 and 650. We're going to see it over $700 with that 10%. The OAS GIS tables that I put out have started to increase more significantly lately with the Consumer Price Index, which is the CPI. And it's doing that. Why? Because we're having higher inflation, I think, as we all know from reading the papers and listening to the news. And now there's, for COVID-19, what we know that with the CERB and the CRB, the Canada Emergency Response Benefit and the Canada Recovery Benefit, and on GIS, we know that there was some bad news the last time. We said that the CERB was going to be counted against, the last time we did this presentation was going to be counted against the GIS, but good news with the bill called C2, and Chrystia Freeland, our responsible finance minister, heard at the FINA hearings, which is a finance committee for the House of Commons, really started to hear that GIS recipients were really suffering because many of them had all of their CERB and their CRB clawed back. And so the government back in, I think it was December 14th, announced that they were going to give all that money back. And so some good news for those 80,000 to 90,000 working seniors. They're going to get the money that was clawed back from them is going to be paid back to them in May 2022 and ongoing for the CRB. When seniors fill out their tax form this year, we are going to be, once again, the government has committed to giving the total money clawed back as a result of the CRB. And there is going to be, and this just came out in the House yesterday, so many people will not have heard this, is there's going to be a special advanced emergency payment for people who are in considerable financial hardship. The rules for all this are like unset jello for this new payment, but at least we can stay tuned, follow the newspapers, follow the media, and hopefully I'll keep it on my website. I'll keep it up to date with the changes. But if you listened to Question Period yesterday, you will know that the NDP put the question to Minister Kara, and Minister Kara announced that they were going to have this special fund. So that's going to be really important. I know people are worried about a number of other things. They're worried about whether when they get this payment in May of 2022 and they're living in seniors housing, is that going to raise their rents? Generally speaking, in Ontario, not immediately. It would only affect your rent if you actually had your rent reduced beforehand because of the fact that you weren't receiving your GIS payment. But it's possible that that will come on to, depending on where you are in the country listening to this, that this could come back and be an issue. So it's something to watch out for. But given the fact that these payments are only looked at once per year now. You don't have a rent review just because you got a special payment in GIS. So I have confirmed that with housing authorities in Ontario. Not clear what's going to happen in other provinces and across the country and in the territories. The other question a lot of people are asking is, I'm filling in my taxes right now, and I'm adding the CRB that I got for a while. Is that going to, am I going to pay extra taxes? And if I pay extra taxes, is that going to be refunded to me over time? And the answer is that's still being worked out. But the federal government, in the mandate letter of Minister Kara, the Prime Minister Justin Trudeau has said that they are to get all their money back. So the question is, what does all, quote unquote, mean? Does that mean any tax you paid? Does it mean you're going to get your rent back if it was charged in seniors housing? And what if you went out to a payday loan outfit because your retail credit was impaired, and you went out to a payday loan outfit and you had to pay interest and that sort of thing? Are you going to get that back? I don't think that's likely, but possibly on the issues of taxation and on the issues of higher rents and subsidized housing, I would simply stay tuned. And if you get a chance, watch Question Period, because it's coming up quite a bit in Question Period from the other parties. So let's get into the table of contents. First of all, in terms of what you need to know, we're going to go through residency in Canada and why that's an issue, what seniors get in Ontario. What does low income mean? We also then have to get in a little bit into taxable income and understand that a bit. Then we're going to talk a little bit about how to reduce taxable income or get money back, understanding the system. Even if you don't have any money, it doesn't matter. You can still do better or do worse, depending on how you arrange your affairs and when you're eligible for GIS, making sure that you apply for it. Once you get a low retirement income that's optimized, how do you protect it? A small section, why didn't I get this advice from the bank? And then how do we spread the word? Okay, so let's get into residency in Canada. One thing I enjoyed doing in the libraries pre-COVID was to first of all get into, I'd ask the question, how many years are there between your 18th and 65th birthday? And of course, there is 47 years between your 18th and 65th birthday, but the federal government looks at 40 of those 47 years between the 18th and 65th birthday, living in Canada, breathing Canadian air legally, in other words, permanent residency. Citizenship does not count one way or the other in this. And so it's permanent residency that counts, and 40 of the 47 years between the 18th and 65th birthday will get you full old age security. Okay, so you don't have to have more than that. So basically it's based on 40ths. So if you have 10 years in Canada, breathing Canadian air legally as a permanent resident, you will get 1/4 of your OAS. And if you have 20, which is half of 40, then you will get 20/40ths, or 1/2 of your old age security. So I'm only talking about old age security for a minute here, and we'll get on to GIS in a few moments. Then it's important to know, and it's on page 35 of my guide called Retirement for Low Income, which is on my website at Open Policy Ontario. And that's all one word. And when you go into that, there is a tab, and the tab is called Retirement on a Low Income. You go in there and you get this booklet. And on page 35 of that booklet, it will tell you of the approximately 200 countries in the world. Canada has agreements with 59 of those countries where 1 year of living in Canada gets you eligible for old age security. So you don't have to wait the 10 years when you turn 65. You only need 1 year in Canada. Unfortunately, there's only one country in Southeast Asia which has that, and that's the Philippines. And there's only one country in Africa, Morocco, that have an agreement with Canada. And there's many agreements in the Caribbean, all over Europe, the United States, and South Korea, other parts of Asia have it. Significantly, China and India do not, which are big immigration sources. But right now, in Toronto, for example, Filipino immigration is the highest group, and fortunately, there is an agreement with Canada. Some people ask the question, why 59 and not all 200? Well, Canada only signs agreements with countries based on the reciprocal nature of retirement. So in other words, if the country that someone comes to or comes from would pay a Canadian who moved there their Social Security, then we'll pay them ours. But it's a reciprocal agreement. If a country says, well, we're not going to pay Social Security to a Canadian who moves to that country, then we are not allowed to sign an agreement with those countries. So there's 59 that have signed agreements, and generally ones that you would generally be in line with the Charter of Rights and Freedoms. So we get a number of the countries that have come through the British system. So Australia, New Zealand, the United States, many countries of the Caribbean all have social security agreements with Canada because they have the same parliamentary system, and it's easier for them to make an agreement. So the list is on page 35, and so if that's of interest to you, go to the list. So in terms of GIS, just to complicate things, the government, for people that have less than 40 years of residency, there is a special GIS on pages 36, 37, 38, 39 of the guide. It gives you some notional amounts of what you would get if you were a low-income person and you were eligible for GIS from an income point of view. There's an extra amount of GIS that tops up the low level of old age security. And just by way of example, 11 years in Canada, at the time when somebody comes and they only have 11 years in Canada, either as an immigrant or as a returning Canadian. And remember, the rules for returning Canadians are exactly the same as they are for immigrants in terms of residency requirements. So 11 years in Canada would result in 29/40ths of the super GIS based on a percent of OAS. The calculation is very, very complicated. And for anybody who is coming from another country, either as an immigrant or returning Canadian, it's really important to know this area. But sponsorship cases are not eligible for the guaranteed income supplement. And as of 2014, sponsorships, GIS recipients will not be will not be eligible for GIS if they are sponsored. Now that sponsorship by the Harper government Chris Alexander, as minister, announced it in 2014. And Jason Kenney, who was Minister of Immigration, it was somewhat of a joint announcement. They announced that sponsorships are now for 20 years. So it would, at least notionally, mean that people who have a sponsorship that goes beyond the 10 years in 2024, because it was announced in 2014, if you're with me, would not be able to get GIS. You should also know that more and more people who are coming over to Canada and who cannot get a sponsorship because there is a lid on them, there is a quota, and they come over on a super visa. Super visa residents are not eligible for old age security because they're still considered to be visitors. So that's an important component of this. And so rather than me trying to explain different countries and the various different agreements, and a lot of them unfortunately are different, which means where you come from matters, and how the agreement is actually set out, it also matters. But helpfully, there are telephone numbers to call Service Canada on Social Security Agreement client case questions. And if you're calling from the Canada and the United States, the toll-free number is 1-800-454-8731. And outside of Canada and the United States, you can call collect to 1-613-957-1954. There's also a website. Their hours of operation are 8:30 to 4:30 p.m. And if you are from one of those countries, or you are a returning Canadian from those countries, it's going to be really important for you to call the number, because then they will put you in touch with the specialist for that country. So, for example, Brazil recently became a reciprocal agreement country, and so they would have a specialist there on Brazil that you could talk to. There's also, when I've done these presentations, there are people who have gone, who have lived part of their life in one country that did not have an agreement, and others that lived in another country that did have an agreement. And someone will ask me, what am I going to get? And my answer is, I have no idea. And the reason is because depending on the amount of years you spent in a particular country, then the amount of years in another country, and then come to Canada. And especially if one is an agreement country and the other one is not an agreement country, there's some complicated calculations that have to be done. But I'm just here to tell you that those complicated calculations can be done, and there are specialists there at those numbers to help you. So let's get into what seniors get in Ontario. So what seniors get, and I'll return a little bit to the immigration and the partial OAS, but I've generally covered that issue now. And we're going to get into what seniors get in Ontario monthly. And really, we're looking at about 7 different sources of income in no particular order. We have the Canada Pension Plan, which is a payroll tax, and the amount of CPP that you are going to get depends on how much you paid in. And not only does it matter how much you pay in a particular year, it also depends on how many years you pay in. And that 40 out of 47 years starts to be part of the equation there too for the Canada Pension Plan. But basically, if you've paid in for 40 years and you've paid at the maximum amount that you can pay in, you'll get full CPP. And so full CPP at age 60 is about $796 a month, and full CPP at age 65 is about a little over $1,200. And that's going to be important because we're going to be saying later on that somebody who is GIS bound, and in other words, they're going to go on GIS because their income is low, and we'll tell you what low income is. We're going to be saying that you should apply for your CPP as early as you can at age 60, because the amount that you get will be lower, and therefore your clawback at age 65 will be lower CPP, lower clawback. But we'll get into that. Old age security is what most people call as the OAS pension. Most people at 65 plus get this. And there's also some benefits for low income spouses, not yet 65, which is called the allowance. And at age 65 right now, as of January 1st, 2022, the amount of old age security before tax, $642.25. So you'll know when you get your T4 OAS in the mail and you look at it and you find that your monthly amount was not 642, it means that you've elected to have some income tax taken off it. And why is that? Because old age security is taxable, as is the Canada Pension Plan. So CPP and OAS is taxable. But once we get to the Guaranteed Income Supplement, or GIS, GIS is not taxable. It is reportable on the tax form, but it is not taxed. It is backed out for taxation purposes. And the amount of GIS right now, it's the single largest payment that we have in the system, and it is $959.26. And depending on inflation, it's quite possible that GIS could get close to $1,000 per month this year. But remember, you're only going to get that $959.26 if you have no other income, no CPP, no interest, no pension, no RRSP cash outs, no nothing. When you have no income, you will get the $959.26. Now that's important in the segue into a program called GAINS, which is the Guaranteed Annual Income System for the aged in Ontario. And it provides you with an income of up to $83 per month, but it only goes to people who have income of less than $2,000 a year, not $2,000 a month, but $2,000 a year. And I get a lot of questions. It says, well, how do I go about applying for GAINS? Well, the short answer is you don't. You don't apply for GAINS. You are going to get the GAINS automatically because the federal and provincial governments share information. The Ontario government will look at the amount of GIS you're getting, decide that you have income of lower than $2,000 a month, and therefore pay into your bank account in the same way as they do with the GIS and the OAS. You will get the extra money from GAINS Aid, but you'll only get the $83 a month if your guaranteed income supplement is $959.26 per month, the full amount. So another form of income people get is income from savings, and that's money you put into an RRSP or a TFSA, or just keep in your bank account, or put into investments of various sorts. Another form is private pensions, which is a pension from where you worked or the different places that you worked. And finally, seniors. And we do know that, many hundreds of thousands of seniors now work because they get money for earnings. And it's really important to the way you know that money is earnings is you get a T4. If you get something called a T4A and you think you've worked, the government doesn't think, or the Revenue CRA, or what we used to call Revenue Canada, doesn't think you've been working for earnings. You've been doing something and getting money from somewhere else, because T4A means other income, and it's usually income other than work. So it's important to understand what the government thinks you're doing. If you think you're earning money, you're going to get a T4, and you're going to get a CPP deduction and an EI deduction, and that's usual work and earnings. But some people are also doing what we might call work, but it's not wages in the usual sense, and they will get a T4A for that. More on that later. So let's get to what low income means, and we're going to be pretty specific here. And generally speaking, we have some, I sometimes call them magic numbers, I sometimes call them break evens, but generally speaking, what these numbers you see here for a single person or a couple in another different situation where different ages of partners and things like that, these are the amounts under which you will receive at least some GIS. So for a single person, if your outside income, not including OAS, the bracket there says if you include OAS, then it's less than 27,171. But generally speaking, we don't like to add on the old age security here because OAS doesn't really doesn't reduce GIS in any way. It floats on top of it. But if you have outside income, in other words, from CPP, an RRSP cash out or RIF cash out, if you have money coming in from investments, capital gains, other different sources, and that amount is under 19,464 a year net, then you are going to receive some GIS. And this is really the important number for single persons. If I know if I'm 63 or 62 and I know that when I hit 65, I'm going to have less than 19,464 from other sources, then I'm going to be a GIS recipient. If I'm a couple and we're both getting old age security, I know that that the amount of our income where we're going to get GIS is going to be 25,728 or less. So if it's only a little less than 25,728, then you'll get a little bit of GIS. And if your income is zero, then you'll get the full GIS. Now, if you have a couple, only one partner getting old age security, and the other partner is under 65, like this could be like the case of a 66-year-old woman with a 21-year-old husband, a little bit of humor there, that the magic number here is 46,656. So any amount under 46,656, then you're going to get some GIS. And then if you have a couple, one partner getting OAS and the other partner is 60 to 64 and getting the allowance, which used to be called spouse's allowance, then the magic number here is 38,048. We'll try to just use, just for simplicity's sake, we'll look at the situation of the single person because it's less complicated than the couples, but also the same sorts of logic applies to this, such that again, I've seen some places they say, well, if you get under $20,000, then you're going to get some GIS. Well, it's 19,464, but right around that amount. So if you're planning, if you're 60 years old and you really know that you don't have any pension, you got very little CPP, you've got there's really no income that you can see coming in, then you're what I call GIS bound. You're on your way to GIS, and you should start planning your finances in that way, that you are that you're doing the things that are going to maximize your guaranteed income supplement. So what we have on GIS is sometimes it's called a clawback. Sometimes it's called a tax back. Other people call it a recovery on it. And that is outside income like CPP. You see the points here in the bullet points. If you take money out of your RRSP, then it's going to cut your GIS by 50%. If you have a pension, it's going to cut your GIS by 50%. If you have CPP, same thing. Investment income, same thing. Wage earnings that are after $5,000 a year, then they're going to be dinged after $5,000 a year at 50%, and honorariums the same thing. So honorariums go back to that reference I made to the T4A. Honorariums come in with a T4A because it's not earnings income. So if you get a few bucks helping out at the church and you're in the basement and they give you $50 out of a cash box, then that's an honorarium. And if you get enough of those honorariums, you just might get a T4A. So that would cut into your GIS, and I've certainly seen that, and I can tell you a bit more about it later. So note, income from old age security does not affect the amount of GIS received. So OAS floats on top of any GIS clawback. So the tax back is 50% on GIS. And just to complicate things a little bit more, there is something called a GIS supplement. So yes, It is a supplement to the supplement. And going back to 2006, when Mr. Harper was first got in 2011, he created something called the GIS supplement because he only wanted the GIS that he's paying out to go to people who had very little income or no income. So he created a GIS supplement that only went to them. So had a dilemma. Well, that's going to increase that magic number, that break even. So how can we do this so that it doesn't do that? So what he did was he increased the clawback on GIS up a further 25%. So it would break even, or the amount under which you would get GIS would stay the same, but he still gave more GIS. Now, Mr. Trudeau, not to be outdone, when he got in 2015, decided that this was a good idea, and in 2016 added to the GIS supplement and also furthered that clawback to 25 by another 25%. So over a zone of income, the GIS clawback, taxback, whatever you want to call it, can be in the 75% zone. And so that's important to just think that there is a supplement there at the low income part. And yes, it is a supplement to the supplement and is a bit complicated. So for those of you, and I always like to make this point, if you've run out of things on Amazon Prime and Netflix and Crave, and you've seen all the streaming and you're thinking, well, what am I going to do on a Saturday night? And I've seen everything I wanted to see and all the Academy Award winners. Well, maybe you can pull out this graph if you're inclined towards graphs, and you can see where the GIS clawback exceeds 50%. And so this is a graph that shows you how the clawback of 50% actually goes up to 75%. And the reason that the graph still works, it doesn't work on so much on the axes, but it does show you that in 2016, using the rates at that time, it shows you that they started to tax back the GIS at 75% in the after $4,600 of income, and then that higher tax back fades out at $8,400 in income. And yes, if you go back to the 2016 budget, I think deeply hidden on page, I think it's page 122 or somewhere around there of a 400-page budget, it explains how this extra tax back on the GIS in that range can occur, and that's still in the system, unfortunately. They don't take the tax back on earnings to any higher than 50%. So it's only higher than 50% between $4,600 and $8,400. So changes in 2020. So a couple of years ago, we had some good news that the earnings exemption on GIS went to $5,000 a year from $3,500. Back in 2009, it was $1,500. And I'll give CARP a shout out. CARP was responsible largely for the government to change it to $3,500. And then a number of us, crew of people who were advocates, advocated strongly for the increase to $5,000. I'm hoping that those of you who are listening will advocate for this earnings exemption to go even higher, perhaps to $10,000. The reason for that is 2006 was a really important year in Ontario. And in the first decade of the new millennium, I think every province in Canada ended something called mandatory retirement. And with the ending of mandatory retirement, it meant that people did not have to quit work at 65. And the general consensus was that they probably would anyways, because a lot of people were taking early retirement. And you might remember something called Freedom 55. And I can see everybody smiling out there because a lot of people are now talking about Freedom 85 and Freedom 95. But in any event, the earning exemption really didn't mean much. And that 1,500 that it was at back in 2006, it didn't mean much because you couldn't work anyways. But then when people were allowed to work, and especially low-income people, and they're trying to make a few extra bucks, then that earnings exemption on GIS really started to be important. Now in 2020, they extended it to the self-employed, so that people who are self-employed could also get that exemption. Before that, if you can believe it, it was not extended to the self-employed. And again, the point that I made earlier about where the recovery rate or the tax back or the clawback, whatever you want to call it, exceeded 50% on the GIS from outside income. For earners, it doesn't. It stays at an overall 50% and doesn't go above the 50%. So complicated, yes. A little bit fairer, yes. Helpful to people who are trying to earn a bit of money, yes. So, but still very, very complicated. So now there's a test. Because we're doing this virtually and we have so many people here, I'm not going to be able to interact with the crowd, so I'm going to run through this. Tina's story. This is an example, and we'll see how well you do. Tina is a single mother receiving social assistance from age 18 to 30. Then she went back to school, worked as a part-time nurse's assistant from age 30 to 50, became disabled with multiple sclerosis and received Ontario disability supports, and now she's turning 65. What is Tina going to get? Well, what will Tina have at age 65? Well, the first one is the Canada Pension Plan, and her average monthly income from CPP is going to be $364. Yet when we look over to the right, we see the maximum payout per month is $1,253.59. Why is Tina getting less than the maximum? Well, there's two reasons. Reason number one is that Tina, as we noted in her history of her work, only worked for some of those years. She was only working for a limited amount of time in her earnings between 18 and 65. And also she didn't pay in at the maximum. So this is reasonably typical of lower income Canadians who don't pay in at something called the maximum yearly pensionable earnings amongst financial planners. They'll call that the YMPE, yearly maximum pensionable earnings, but the her YMP, she was not there. She was much below it. So she put less money into CPP, but she also didn't put it in for as many years. Now her old age security is going to be $642.25 and the maximum is $642.25. Why did she get the maximum? Why? Because she was 40 out of the 47 years in Canada, breathing Canadian air as a resident of Canada, permanent resident of Canada, breathing Canadian air legally. So then we come down, let me go down a couple of rows here. She's not going to get anything from the gains program. It's zero. Why? Because her net income for GIS purposes is over $2,000 per year. Remember, it's $2,000 a year. So even the $364 a month in CPP is over $2,000 a year. It's closer to $4,000 a year. So she's not going to get any money from gains. But she had income from savings of $10, private pension of $90, and so let's go back to that line. She's only going to get $610.38 per month in GIS. Why? Well, if you take the $364 that she gets in CPP and you take the extra $100 she gets from savings and private pensions, she's up to $464 per month. Don't try to do the math because of the differences in the rates of GIS clawback, but that amount of money, 50% of that $464 is going to come off her GIS in nominal terms. Okay, 50% of 464 is $232 that's going to come off her GIS, and then she's in that zone of the extra clawbacks. So number 610.38. I'll probably rework the numbers. I think she might get a little bit more than that now with GIS higher. But anyways, Tina is someone who's in shallow poverty. Her total average monthly income, along with her refundable credits, and remember, refundable credits are like gift cards, and we'll get into that a bit, is 21,667. The poverty line for a single person, the Canada's official poverty line called the market basket measure, is now in about the $24,000 range, depending on where she lives. So she's a person that we would call living in shallow poverty. So she's a senior, part of the few percent, the 6 to 10% of seniors who are living in poverty. But generally speaking, most seniors who live in poverty are living in what we call shallow poverty as opposed to deep poverty. So it's important, if we go back now 3 years with the new old age security and GIS form, there is a part of the OAS form that says to you, very consequentially, it says to apply for GIS, complete questions C2 to C10 below. And then it says, just sort of quietly, if you don't want to apply for the GIS, check this box and go to section D. So my advice to anybody who is anywhere near the amount of money, like that 19,000 odd money as a single person, and you're thinking, well, maybe I shouldn't apply for the GIS because I probably won't get it. That is, you can hear the wrong buzzer going off right now. If you're anywhere close, don't tick the box. Leave the box to the ticks. And I got a little graphic there that shows a tick box. And so the tick is inside the box, so you don't have to tick it. So don't tick the box if you're anywhere close. One of the things that you'll find on this OAS form, and I'll just stay here for a second, is it tells you at the end, right about when you're about to sign it, it'll say, if you say that's anything that's inaccurate, if you say something that isn't right, if you say something that the form will tell you something to the effect that you could be charged under the Income Tax Act, that you could be charged under the Old Age Security Act. All sorts of horrible things are going to happen to you if you don't fill out the form properly. And I know from personal experience that there are people that did not apply for GIS, even though they were eligible, just because they got cold feet when they thought that that they might be going to the Crowbar Hotel if in fact they left the box unticked and their income was slightly above the GIS. Let them figure it out. Let them figure it out whether you are eligible or not. You've just put your money in. They'll go look at your tax form and decide whether you're eligible for the GIS. So don't tick the box. So if you're out low income, don't tick the box. If you're unsure, don't tick the box. No need to worry. Don't tick the box. Fill it out. Answer all the questions. And of course, file your taxes. If you don't file your taxes, the federal government will believe that it does not have the information to provide you with your GIS, even though they likely already do, but they don't think they do. And because they don't think they do, you have to file your taxes and make sure you keep everything up to date. So there's 43 basic questions on an income tax form. Some of them are repeats, but they ask you a few things. And as long as you answer those 43 questions, those basic questions, then you will be assessed for GIS. And so the application for the Guaranteed Income Supplement in Ontario, I live in Scarborough, so I know this building is there. I go down to Scarborough Town Center for postal codes beginning with L, M, or N. You send it to the Service Canada building in Scarborough Town Center, which is Post Office Box 5100, Station D, Scarborough. And for postal codes beginning with K or P, make sure that you send them to the Service Canada office in Timmins. if you get it wrong, it just takes extra time. So try not to get it wrong, and look at your postal code and make sure that you're sending it to the right place. Now, in the old age security application form, it has a long list of places to send them. So if you're in another place in Canada, Alberta, BC, Saskatchewan, Newfoundland, Labrador, Yukon, whatever, there's going to be different addresses to send it to. So pay attention to that sheet of paper that gives you all of the addresses so you send it to the right place. So what we really need to do here now is to review what forms of income do not reduce GIS. Really good question, because a lot of forms of income, as we saw, CPP, it reduces your old age pensions, RSP cash outs, all of those things reduce your GIS. And so as a low-income person or planning for retirement on a low income, you want to be in forms of income to the most that you can that do not reduce your GIS. So right off the top, as we noted earlier, old age security does not reduce your GIS. So don't worry about getting old age security or trying to pay extra tax on it, as I've heard some people do. So they say, well, then my GIS might be higher. No, old age security does not reduce your GIS. But one of the big ones is that a tax-free savings account, a TFSA, money that you take out of a TFSA, does not affect your GIS. So let's say you're thinking, I've been doing retirement planning and I have an RRSP and I have a TFSA and I put money in my TFSA and I put some in my RRSP. If you're low income, maximize your TFSA, forget about your RRSP. Why? Because when you take money out of your RRSP, you are going to pay 50% on the dollar in terms of GIS clawbacks. And when your chariot turns into a pumpkin and your RSP turns into something called a RIF, a registered retirement income fund, once you reach age 71, then you're kind of locked in, and you will lose money off your GIS if you are under those income thresholds that we looked at earlier. Now, also something called an RDSP, which is another tax instrument for people with disabilities, the Registered Disability Savings Plan. Money that's withdrawn from that does not reduce your GIS. That's a very frequent question in the in-person library visits, certainly that I've made, and then and others too. And refundable tax credits you get with your income tax refund. Child benefits. In Ontario, there's something called the Trillium program, which is the old property and sales tax credits. Your working income tax benefits, which is now called the Canada Workers Benefits, and your GST credits. Any of those refundable credits, which are really gift cards from the government, regardless of whether you pay tax, those do not reduce your guaranteed income supplement. So we want to be able to get our OAS. We want to have as much money in our tax-free savings account as possible. And right now it's up to over $70,000. If you've never put a cent in a TFSA, you can put $70,000 as long as you've been living in Canada in the year that to which you're trying to associate with your TFSA. So I can say, for example, that I've met into people that haven't put a cent into a TFSA and they've been breathing Canadian air legally since 2009. They can put in the whole $70,000. I think it's $70,500 that you could now put in. But then I've talked to people who came to Canada, let's say in 2018, and they said to me, oh, you know, the first thing somebody told me about a TFSA, I'm going to put $50,000 into my TFSA. And I said, well, no, you're not. You can only put in the money for the year for the years that you've been living in Canada legally and as either a permanent resident. Those are the only. So it's throughout the TFSA. They started at $5,000 a year. They went up to $5,500. I think for 1 year under Harper, they went up to $10,000, and now under Trudeau, they're back to $6,000 a year. So you have to look at the year, count up the years that you've been in Canada, and the amount of the TFSA contribution for that year, and then that's the amount of money that you can put in. So an RRSP versus a TFSA, are they the same? Yes and no. RRSPs are exactly the same as TFSAs in terms of what you can put into them. So you can, in a TFSA, you can put cash, bonds, stock, exchange traded funds, GICs, and you can do the same with an RRSP. If I had a dime for every person that has told me that they believe that the sort of income that you can put into a TFSA is different than an RRSP, I'd be close to being a lottery winner. The amounts, but that's where the comparison really ends, because in RRSP, you earn RRSP based on your earnings, and it's 18% of your earnings that counts for your RRSP room. So that's amounts over the years that you can accumulate. It doesn't run out, you don't lose it. And the same with the TFSA. Instead of having anything to do with earnings, the TFSA looks at your residency, your legal residency, your permanent residency in Canada since 2009. So trivia question, when did RRSPs come in? That was 1957. When did TFSAs come in? In 2009. So the TFSA program is not what we would call a mature program because it keeps adding the amounts that you can put into it since 2009. So it's a very small program in the first couple of years, but now it's starting to become a lot more significant. So if you get a low income person with a lot of RRSP room and you're approaching 65, the last place you should be putting it into is an RRSP. You want to put the money into a TFSA. Why? Because when you take it out, what happens? Nothing. If you put money into an RRSP, when you take it out, it's going to result in a 50% at least clawback of your guaranteed income supplement, which, as we've just learned, is about the largest single tax-free form of income that you're going to get from the government after age 65 if you're a low-income person. So what does taxable income mean? Let's talk a little bit about the tax system. And generally speaking, taxable income is the amount on line, which is now called 26,000, but it's line 260 of your tax form. It's line 260, 2020, 21, 22. And generally speaking, and this is just a rule of thumb, it is not, everybody's different. Some people put money into RSPs. They'll have other tax deductions for childcare and RSPs. People get different amounts of non-refundable credits depending on whether they are of an advanced age or whether they have a disability. So if you have a taxable income, it's about $16,500 and you're under 65, you're unlikely to pay likely to pay any tax because you have non-refundable credits that give you an exempt amount of about that amount of money, and your taxable income about $22,500 if you're over 65. Again, these are just general rules and are going to apply. They're just notional, something to keep in mind about where am I going to pay tax, and again, these are amounts for single people. So how to reduce taxable income or get money. We need to understand a tiny bit about the tax system. I want you to introduce you to a number of terms that I've been using here, which are probably making you nervous, and some terms that a lot of people really don't understand how they work. And I know this because I always ask this fateful question whenever I was in the libraries in the real bricks and boards, and I said, can anybody tell me the difference between a non-refundable credit, a refundable credit, a deduction, and an exemption? And I could just see by the feeling of the room that's like, please don't ask me. Or people would answer the question by starting out saying, that's like when. And I said, well, it's not like when. Tell me what it is. Can you? Don't give me an example of it. Tell me what it is. And very few people actually know that. So we're going to talk a little bit now about non-refundable tax credits, refundable tax credits, exemptions, deductions, and entitlements, just so we know what they are. So let's start with a non-refundable credit. Now, a non-refundable credit, and I've used, I keep this slide because governments never seem to tire of changing not only the non-refundable credits, but what they call them. They rename them from time to time. And a non-refundable credit is like a coupon off your taxes. So if you owe taxes, you get a non-refundable credit. It's like a coupon off that taxes. So we had something called a child fitness credit, and it was non-refundable. It was a coupon. So if you didn't pay any tax and you're low income under those amounts that I showed you just a little earlier, then they don't mean anything. They're of no value to you. And the medical expense tax credit, which a lot of people keep a lot of receipts for and then end up not getting anything from it. Education tax credits, tax credit for full-time post-secondary students. Transit tax, past tax credits that were in for a while and then they're out for a while and now they're back in again. And some of them are coupons and some of them are gift cards. Now, one of the big ones is the charitable donations tax credit, and it is a non-refundable credit. Again, it's like a coupon. And then we have a disability tax credit, and it's a non-refundable credit. It's like a coupon off your taxes. Spousal tax credits, caregiver tax credits, all of these are non-refundable like a coupon. So if I were to, let's make a distinction here, or let's talk about going to the drugstore or the grocery store and see if that analogy works. So if I go into a drugstore and or a grocery store, and I've decided I want to get a big tub of Tide detergent. I chose Tide because most often there's coupons in the store for Tide, often, $5, $6, or $7 that you can get off a tub of Tide. And so you notice it in the newspaper or the flyer, and you go into your store and you go and get your Tide and get your money off it. But one thing you can't do is take that $7 Tide coupon and go to the cashier and ask for $7. Why can't you do that? Well, the cashier is going to tell you, somewhat surprised at you, saying, well, you have to buy Tide in order to get the $7 coupon. Well, if you're in the government store, it's the same way. That $7 non-refundable credit is only worth anything if you pay taxes in the first place, like the equivalent of buying Tide. And so if you're paying taxes now, then a non-refundable credit is worth money to you because that coupon is a coupon off your taxes, and that's what a non-refundable credit is. Now, I want to make a distinction between that and a deduction. And people are often not able to explain a deduction. So if we take you back to the store, and let's say let's say you walk into the store and you got your Tide and you're going out with your Tide. If the non-refundable credit, if the coupon was the same as a deduction, the cashier would look at you and say something like, how much money did you make last year? And you'd say, what do you mean? How much money did I make last year? Why are you asking me how much money? And he or she looks at you sort of exasperated and says, well, I needed to know how much money you made last year because I need to know the value of the coupon. You say, well, that's odd. Why would I need to know the value of the coupon? Well, that's exactly how a deduction works. So let's say I'm an ordinary working guy and I make $50,000 a year, so I'm paying taxes, and I take my tub of Tide to the checkout counter and I give my $7 coupon. How much money am I going to get off? Well, I'm going to get $7 off because non-refundable credits are coupons off your taxes, and that's how they work. So then let's say I'm not this working stiff. I'm Conrad Black or Frank Stronach or somebody with a whole lot of money and a big tax bill, and I will walk up to the cashier and how did I make my money in the first place? By saving it and clipping coupons, and I hand in my my coupon. How much am I going to get off the tub of Tide? It's not a trick question. I'm going to get $7 because that's how a non-refundable credit works. But if it was a deduction, that cashier is going to ask Conrad Black, how much money did you make last year? Because they wouldn't know the value of the deduction, because a deduction actually reduces your income. Okay. And there's two big deductions that ordinary Canadians get. And those two, richer Canadians, there's all sorts of different deductions, but there's one of the really the big deductions is the RRSP deduction. So if I were to reduce my income, if I had income, let's say of $100,000, and I take out a $10,000 RRSP, I put $10,000 into my RRSP, and my tax rate is 50%, then that $10,000 RRSP contribution is worth, that deduction is worth $5,000. Now let's go back and say I'm that $50,000 working guy, and my tax rate is 20%. That same $10,000 RRSP contribution, or if I pay $10,000 in childcare, then that deduction is going to be worth $2,000. Why? Because my tax rate is 20%. And for the rich person, it was 50%. And then let's say I am a person who has no taxable income, then my deduction is worthless. It's zero because I already at the point where I don't pay any tax. So getting further tax credit is not going to do me any good. And I think there's a lot of low-income people who give to charities that don't really understand that they're not getting any money back, and they're getting no money back because they don't pay tax in the first place, and therefore getting a coupon off their taxes is going to be somewhat the same as trying to go to the cashier with a Tide coupon when you don't buy Tide. So it's really important to understand that. So in the case of the deduction, you're lowering your income. In the case of the non-refundable credit, you are lowering your taxes. And they are slightly different, as you can see in and the deduction is worth more to the richer person because their tax rate is higher, and they're worth less to the person whose tax rate is lower. Whereas the non-refundable credit, the amount of money that comes off your taxes is the same, just like it does with an ordinary coupon. So there's a $7 Tide coupon, just to take a look at one. And here's some other coupons that we have here, just pictures of them. Now we want to get to refundable tax credits. And refundable tax credits in the government store are like gift cards. Okay, so it's redeemable for money. If you have a gift card and you take it in the store, maybe you can't buy lottery tickets and cigarettes, but you can buy most everything else. And so that's the same thing. If you have a gift card, you give the gift card in, and then it has that value. It's not, its value doesn't come off something else. It doesn't lower your tax. It is an amount of money that works in the same way as a gift card. So your GST and HST credits it's a government gift card. It's a refundable credit. The Trillium benefit on Ontario, the working income tax benefit, which is now called the Canada Workers Benefit. Got to change this graphic at some point. The child benefits that used to be divided into the UCCB, the CCTB, and NCBS, OCDB, and child disability benefit, all are now under the Liberals in 2016 made them all into one thing called the Canada Child Benefit, payments for children living with their children. So what is the difference between a refundable tax credit and a non-refundable tax credit is roughly the same difference between a gift card and a coupon. So you know when you go into the store what a gift card looks like and what it will do, and you know what a coupon will look like. So the analogy is very, very close. And so what I'd like your thought balloon to be is when you hear the term non-refundable credit, just blurt out, that's a coupon. And then if you have a refundable credit, that's a gift card. Now, what you'll often see in the literature will say, oh, if you do this, you will get a tax credit. Well, I'm pulling my hair out, what little left of it, saying, what kind of tax credit? Is it refundable or is it non-refundable? Will I get some money off my taxes if I pay taxes and nothing if I don't pay taxes? Or will I get a gift card from the government because it's designated to be a refundable credit? And this is why almost everybody should file their taxes. You know, if you're in the Panama Papers, get a lawyer. But if you are, most people should file their taxes because they're leaving gift cards on the table. Again, if I had a dime for every person that says, well, I don't file my taxes because I don't owe them anything. Yeah, you don't owe them anything, but you are leaving a host of gift cards on the table, and you should see the smiles on the faces of people who haven't done their taxes for years. They go into a social service agency, get somebody to help them with their taxes, and they get their refundable credits back for years and years and years. Other people say, well, I'm kind of scared because I think I owe them something. Let me tell you, the amount that you may owe them after 5 years or 10 years doesn't hold a candle. It's going to be nowhere near the amount of money they owe you. So refundable credit started in 1978 in Canada with the first child benefit. There has been no new income security program in Canada that has not been a refundable credit. I used to be able to say this without reservation, but the CERB and the Canada Recovery Benefit are not refundable credits. They're paid out as taxable benefits, just like old age security or CPP. And in many ways, and they're application based now. So they're the exception to the rule, but most benefits who have been paid out by government since 1978 have been refundable credits. So, and you see those in the stores too. You can buy gift cards, and you know how a gift card works. You know how a coupon works. Now you know what a non-refundable credit and a refundable credit works. And then finally, tax exemption. These are things that you don't have to, that you either don't have to report or you don't pay tax on the first place. So if you win at the racetrack, the sale of your principal residence, you have to report, but you don't pay any tax on it. Sale of your car, your garage sale proceeds, reimbursed expenses. Now, on any of those, you might have to pay HST or GST, but we're talking about income taxes here, and there's certain things you don't need to report and you don't have to tell the government about. And so those, in a sense, are like exemptions, although that formal term is not used anymore. But there's certain things that you don't have to report. So if I were to, and again, size does matter. So let's say I had 2 copies of a book and you're over at my place and somebody says, hey, I got to buy that book off you. You got an extra copy. I don't want to take it for free. I'm going to give you $10. Now, would I then turn around and say, you know what? I'm going to have to charge you GST on that book. You know, you wouldn't think that much of me, or you think I'd be sort of like being picky. Well, the government really doesn't care about that. But the reason I say that size does matter is, let's say instead of selling you 1 book, I start to sell you 100 books or 1,000 or 10,000. The government starts to get interested depending on the size of the transaction. So we all know about that. So it's a gray area. But again, small things, sell your car, garage sale, reimbursed expenses, they're not that much interested in. So deductions, again, are there's only 2 really, really important ones. Is the child, for people who are low income, is the child care and RRSP deductions. And those deductions actually shave money right off your income. So if your income is $50,000, you got $10,000 RRSP contribution, then your income goes down to $40,000, from $50,000 to $40,000. And so if your tax rate changes, then the value of the deduction changes. With non-refundable credits, they don't change. They're like true coupons. So I'd like to say a little tiny bit about entitlements for a bit. Entitlements are items in the income security system that don't come through the tax system. We have a number of entitlement programs. We have programs like Canada Pension Plan is an entitlement, EI is an entitlement, social assistance is an entitlement. So we have various different programs like that. The CERB was an entitlement type program that was taxable, and the CRB was the same. But the issue with owning something, even though you own your credits, you have a certificate of possession, you own it, you're entitled to it. You still have to provide documentary evidence. And the one I'll cut it short here. The one that I like to use is vehicle ownership. And if you are driving down the street, minding your own business, and then all of a sudden you see a light on a car behind you and somebody is motioning you to slow down, I can hear everybody channeling that experience. Everybody knows it, and the officer comes up. You wind down your window, and you are going to be asked, at least in Ontario, you are going to be asked for 4 items. You're going to be asked for your license. You are going to be asked for your vehicle identification, your ownership, as we sometimes call it. You are going to be asked for an up-to-date proof of insurance. And you're also going to be asked to show a little sticker on your VIN, which the officer will also go around and look critically at your license plate and see if the date on that little sticker is before today's date. You can be in the position, and this happened to me once, where I got 4 different fines because I decided to go out and buy some plants over at my local Home Hardware, and I went over in my shorts and didn't have my wallet, and I was stopped, and I got tickets for no license, no vehicle identification, no sticker. I had the sticker on the back of the car, but I didn't have the little sticker on the ownership because I didn't have the ownership with me, and I didn't have my insurance because I didn't have my wallet. So I had fines that were going to total somewhere around $665. The whole point of this is that this is the same thing. You might own your car and you might own it outright. You don't have any money owed on it, but you know what? It doesn't matter. You still have a responsibility to keep it up to date. And I use this analogy because I run into too many people who say things like, when I said, did you do your taxes? Did you apply for the benefit? They will get vague, and they will say something that always surprises me, is that, oh, I'll wait for them to catch up to me. Are they going to catch up to you? The answer is 2 letters, N-O. No, they're not going to catch up to you. For benefits, you have to apply for them. You have to meet ongoing eligibility requirements. You have to file your tax returns, and you have to show documentation, and you have to update the documentation. It's not that much different than driving your car without your wallet or your purse. So it's, I always say to people, it may be, yes, your entitlement means you own it. It's yours. You're a Canadian. You've met all the rules, but you do have to go through the application process, just as you have to keep your wallet and purse in the car. So what's a tax refund? Nobody ever gets this right. A tax refund is the combination of refundable and non-refundable credits, gift cards, and coupons. Now, when I asked the question about the refund, people always say, well, if they owe you more money than you owe them, then you're going to get a refund. And then if you owe them more money than they owe you, then April 30th is an important date because you're going to have to pay your taxes by that date. That's true, but the actual composition of your refund is going to be largely a combination of your gift cards from the government and your coupons from the government, and then the amount that you've earned, and then the tax rate on that. So just as you might go into to a drugstore or grocery store and you hand over a bit of cash and you hand over a couple of gift cards and you hand over a couple of coupons and you end up getting money back, that's kind of like how a refund works. And if you hand them cash, a $20 bill and a couple of gift cards and a couple of coupons, and the cashier looks at you and says, I still need $8.35, that's somewhat the equivalent of what happens in a store is equivalent to what happens in the government. We all have, generally speaking, refundable and non-refundable credits that apply to us, and then we either owe or we get money back, and that's how it works. So let's go into protecting low-income retirement. And the first question is, should everyone apply for, will the government tell you about everything you're entitled to? And the answer to that is, don't count on it. Many, many people are going to, once they start hearing Paul McCartney's song from Sgt. Pepper's, which is When I'm 64, when people are starting to send you funny notices with that song, a stream of that song in it, or a link to that song, rather than listening to the song, well, you can listen to the song, but the other thing you should do is say, oh, it's time to apply for old age security. You should apply 11 months in advance. I have met 5 people so far in 2022 who says, I'm turning 65 next month. Do you think I should apply for OAS? You think you should have been applying once you turn 64. So why? Because it takes that long for them to get through the information, and especially if there's any more information they need, if your birth certificate has any problems with it, if your entry papers to Canada, if there's any dispute about when you came to Canada, your landing date, you get that stuff out of the way, and get that out of the way before you turn 64, and then apply cleanly on 64 in 1 month, and you'll probably get your old age security, 1 month after your 65th birthday. But don't wait around during that 64th year, because that doesn't, you're really putting it into jeopardy. Remember not to tick the box for GIS on the OAS form. They will tell you if you qualify for gains, if you have very, very, very low income, and file your taxes to make sure you get other credits and benefits, and your GIS will be renewed automatically each July. So if you file your if you applied for the benefit and you didn't tick the box and you filed your taxes, you don't have to go through any reapplications. So that's another real reason that everybody should file their taxes, especially for GIS purposes. Remember, the OAS amount is a set amount, but the GIS is income tested. So it's important you do that. Now, why do some people get the OAS forms in the mail? If they get a pension, the pension people are going to make darn sure that you get the OAS form at 65, especially if you had early retirement, because it's going to meld with your CPP and probably your pension. The amount of pension they want to pay is going to go down because your CPP and your OAS are going to go up. So it's really in their benefit to make sure that you don't lose any income. If you're receiving social assistance, you are going to get the form for sure, because they want you off at 65. And you also, some employers simply just make it part of the deal. They'll notice what your age is, and they'll they'll get it for you. But if you're self-employed or unemployed, or you're off the grid in any way, shape, or form, they're not going to send those forms to you. So you got to bird dog it and make sure you're going to get it. So should everyone apply for OAS? The answer is yes. Do it as you approach age 65. A lot of people are enrolled automatically and will receive a letter to this effect. Only apply if you don't receive the letter. Even if you have not been in Canada long, some people say, oh, you know what? I haven't been in Canada long. I just came back from a lifetime abroad. I'm not going to get any OAS. I've heard that many, many times. But if you're a returning Canadian and already had 10 years residency in Canada, say from 18 to 28, and then you spent a long career abroad, you know what? When you turn 65, you're going to be eligible because you got those 10 years. And if you're in one of those countries, the 59 countries where there's a reciprocal agreement, it may be that, for example, from the Philippines, Morocco, Jamaica, United States, UK, New Zealand, Australia, any of those places have reciprocal agreements. And if you came into Canada at age 64, a year later, you're going to get old age security, and there's not going to be any restriction on it. And you should apply for it. You might only get 1/40th, or maybe you came to Canada when you're 60 and you're only going to get 5/40ths, but at least you're going to get something. And it doesn't make any sense to wait longer because you're just going to get less money. So if you qualify for OAS and you have low income, you're going to qualify for GIS too, unless you're sponsored. That's the only real prohibition. So should you work after age 65? Really, really good question. Again, we talked about the issue of mandatory retirement, and mandatory retirement in the first post-millennium decade, 2000 to 2010, all provinces and territories got rid of mandatory retirement. And we see that, in those years before mandatory retirement, you see a lot of people leaving the workforce before age 65. What happened when we get into the early 2000s sort of flattened out. And then whether we see junior seniors, more senior seniors, men, women, doesn't matter. Everybody started working. So kind of unexpected. Some ways, I guess, demographically, it was expected. In terms of income, people say, I got to keep working until I'm 80 because I'll never have enough. Anyways, more Canadians are working post 65. And so it becomes a real question. But should you, after 65, if you're GIS bound and you're on GIS? Here's another one. This is just... I think this graph here is only for women, and it shows just how spectacularly after leading up to 2006, especially, and in those early years after 2000, when everybody knew that mandatory retirement was on its way out, we we're going to be you see more and more Canadians working. Employment rates for both sexes. You can see the employment rates for men and the employment rates for women. Something was done by Peter Hicks, who was working for Stats Canada. Gave me these slides here. It's really quite dramatic, and because of that, we have to look at the low income thing. So what I'm going to tell you is you should either work a little or work a lot if you're a GIS recipient. And why is that? Because any net income reduces the benefits that low-income seniors get, except for $5,000 in net earnings. So work to the $5,000 if you're a GIS recipient, and then stop. Then if you decide, look, I'm really going to work, and I'm going to seriously work after 65, and I'm going to make more than that $19,000, say as a single person, that $19,000 threshold that we saw early, somewhere between $19,000 and $20,000, and I'm going to earn more than that. You're not going to get any GIS, so just forget about it. Work and work happily. But if you get stuck in the middle at about $10,000 or $12,000, the amount of money that's going to be reduced, and especially if you earn about $8,500 a year, the amount of money that's going to be clawed back off your GIS is just so high that in many ways is not worth it, especially when you think of work expenses, other things that you have to pay for because you're working. It's not something that I find very pleasant to say, yet at the same time, from an economic standpoint, I've run into a lot of male Walmart greeters, guys in Canadian Tire and that sort of thing, hardware stores where a lot of older, lower income guys like to work, and then you find women working in fast food, usually outside of Toronto. And those people will tell you, I earned some money, but at the end of the day, I don't seem to be any further ahead. And the reality is they're not, because the reduction rates on GIS, especially, are quite high. And then when you think of other things, you're paying into EI. And at 65, of course, you don't have to pay into CPP anymore. You can get a form and hand it to your employer and say, look, I don't want to pay into CPP anymore. If you do, you can get something called a post-retirement benefit between 65 and 70. That's called PRB. So if you got a computer, you can Google it, the post-retirement benefit. I would generally advise against it. Just stop paying into CPP at that point. You'll be forced out of it at age 70 in any event. And then we have to think about honoraria and RSP. So I'm going to give you some more examples of this, but let's, for minimum wage earners, I've sort of taken the St. Patrick's Day as a rule, because minimum wage of $15 an hour, you're going to earn $5,000 by St. Patrick's Day. And after that, every dollar is taxed back at 50 and possibly 75% over those income zones. If it's only earnings, you'll only have 50% clawback. But really do think about working after St. Patrick's Day if you are going to stall out at $10,000 or $12,000 or $14,000. It's only, so that's why I say work a little or work a lot. Work up to the 5,000, or then make the decision that you're going to make over $19,000 a year, and you're going to forget about GIS as an income source completely. So I want to say a little bit about honorariums. It's a very controversial area because you have people. Philip's story. Philip was homeless. He's also fairly severe mental health issues. He was on something called the Dream Team that he spoke. He did speaking arrangements talking about what it was like to be homeless and how he got housing and that sort of thing. Quite inspirational. Philip's still around, hear from him every so often. But one year, back in 2015, when he first turned 65, Philip said to me, he said, how much money am I going to pay in rent in my senior's housing? So I worked it out for him, 30% of his income. And I said, Philip, you're going to pay $428 a month. So that was all good. Philip then called me back or wrote me back about a couple of months later, and he said, I only have to pay $410 in rent. I have to pay less. How come you told me it was going to be so much more, another $18, $20 a month? Well, that's when I asked to see his income tax information, and I realized that he had received $1,490 in honoraria. And he was very low income. He had almost no CPP, and he was below the $2,000 a year. As you can see, he only got the $1,490 in honoraria, and so the gains program clawed it back at 50%, and GIS clawed it back 50%. So Philip got nothing, and he'd get nothing until he got beyond the gains aid clawback zone of $2,000. So they took all his money. All of his honoraria, and he didn't know this was going to happen. I didn't know it was going to happen, but then we started seeing this. So what you need to know is that the T4A slip trigger point is $500. Now, in some ways, I'm just skirting the edges of tax cheating, because even if you were to get $400 in honoraria from one place, you still kind of on the books, you're legally obligated to report it. But what I'm telling you is you're likely not going to get a T4A. Because a issuing agency, whether it's some stuff in a church basement or a nonprofit that you help out with that got a little bit of money in the till to help out with honorariums for low-income people, if you're helping in a soup kitchen, they don't have to issue you a T4A until $500. So I advise people, probably in some senses, it's probably getting close to breaking the law, if not breaking the law. But if you stop collecting honoraria at $4.99, you're likely not going to get a T4A slip. So the Canada Revenue Agency is not going to know that you had this honorarium, and volunteer for another agency for the next $4.99. And then we'll talk about the point at which you would contribute to an RDSP in the next 11 minutes when we get into our discussion period. So should you take early CPP? The answer, the usual age to take CPP is 65. Early CPP is age 60. It's a little less money, but you may need it now. This strategy doesn't work at all if you're on social assistance. Don't take it early. That's ODSP or Ontario Works, because your social assistance will be clawed back. But at that, really saying that you ought, remember going back to that slide about Tina and the earlier slide that showed you what you get, $796 at age 60, and you get over $1,200 at age 65. The GIS clawback is 50%, generally speaking. So 50% of $1,200 is a lot higher than 50% of $796. So if you take CPP early, you'll get all that money between your 60th and 65th birthday that you probably needed. Even though it's taxable, you'll be paying at a low rate because you're low income. But at 65, your GIS clawback is going to only be on the $796, the lower amount. It's not going to be on the higher amount. So you're much better off to take early CPP at age 60 if you're not receiving any form of social assistance. If you're just living on a fixed income of some sort, or you have very, low earnings, you can still take the age 60. Since 2012, you've been able to take your CPP without quitting your job. A lot of people still think you have to quit your job, but you don't. You can take the early CPP at age 60. Just a quick slide. This is mainly for social services agencies. Don't sign everybody up for CPP at 65 if they haven't already done it. Some people have really, really low income, like Philip, and in those instances, you should be waiting to age 70 to take CPP, because remember, your clawback on gains and GIS together is 100%. So if you apply at 65, guess what? You're going to lose all your CPP. So wait until you're 70, and then maybe you'll go over that threshold of $2,000 per year at that point, and then not have it all clawback. So after age 70, there's not, you wouldn't get that clawback. So the next part, and really we're getting towards the end, is the parallel universe of low income retirement. And there's a certain type of parallel universe where everything is the opposite. White is black, black is white, up is down, down is up, east is west, west is east. The moon is green, the sun is pink, the sky is brown. It's just a completely different universe. And that parallel opposite universe is the universe you're in. So why is retirement different for low-income people? Because most middle and high-income people have less income after they stop working. Most low-income people have more income after their 65th birthday. Most middle and high-income people pay less tax after they retire, but most low-income people don't pay tax in the first place. but they might have to when they start getting CPP and OAS. So everything's in this topsy-turvy opposite world, and I would almost say that somebody who doesn't understand low-income retirement at a bank or a credit union most often would give you advice like, well, wait till you're 65 until you get your CPP, or even wait till 70 because you'll get more. And they'll tell you only go into a TFSA after you've maxed out your RRSP, although fewer and fewer are saying that, but that's what they used to say. And you get people pretending that you're a higher income person where all these rules would apply. But the opposite rules really apply when you're lower income. So it means that, and this is part of the parallel universe, what I've said before is that you should not get into RRSPs if you're GIS bound. You should sell them and get out of them as much as you can before you're age 65 and put that money in a TFSA. So only when your CPP, OAS, and other income means you might have to pay tax, an RRSP can increase your GIS as RRSP contributions can increase GIS. Okay, so if you got an RRSP and you're taking money out of it, it's going to reduce your GIS. But if you wait until 65 to put money into a GIS, it has the opposite effect. It will increase your GIS. Why? Well, remember back when we said we only had a couple of deductions left in our tax system that really apply to most people, the child care and the RRSP. It's a deduction. So it will reduce your income. If your income is reduced, you will get more GIS. And the good news is you can buy an RRSP between the age of 65 and 71. So I have seen people that have an awful lot of RRSP room, and that RRSP room, especially for very low income people, will often be quite fancy. I knew one woman who worked as a social services agency with me who had $150,000 in RRSP room. Why? Because she never put money into an RRSP. So she's turning 65. And I said, well, start putting money into an RRSP now, and you'll go from no GIS to 900 and almost $1,000 a month. That's just by putting money in the RRSP. Now, of course, your RIF's going to be higher. I'll say a bit about that in a second. You're going to have tax pain by taking money out before age 65, 10% up to 5,000, 20%, 5 to 15, and 30% over 15,000. But it's refunded if you don't pay tax. But even if you do pay tax, it's still less than the 50% and 75% reduction on GIS, plus the tax that you will pay after age 65. So that's, even though you have to pay tax on it, cash it out before that. A lot of people don't want to do it because they'll pay tax on it, but they're going to lose more money on their GIS clawback reduction than they would in the amount they would pay. So your notice of assessment is a gold mine, because at the bottom of your notice of assessment, you have something called your RRSP deduction for the current year. And if you got a lot of money in it and you're close to that GIS threshold, then you can put money into your RRSP, lower your income because it's a deduction, remember. And when you lower your income, then you become eligible. You're turning on the GIS tab. So taxable income before and after retirement. Just remember, before age 65, you have earnings which are taxable, but if you receive Ontario Works, it's not taxable. ODSP is not taxable. Pain and suffering awards are not taxable. Some structured settlements of various sorts are structured in a way that you don't pay tax. Inheritances are not taxable if the person giving the money has paid the taxes up front. After age 65, your earnings is taxable, your CPP is taxable, your OAS is taxable, your RRSP cash outs are taxable, your private pensions are taxable, and your investment income is taxable. So you're trading possibly a whole suite of non-taxable benefits. Turn 65, all of a sudden, everything except GIS is pretty well taxable, and that's the important thing. RRSPs are for people who pay taxes. They help to pay less tax now, but you pay it when you take the money out. And that makes sense for higher income people because they're going from high income years to low income years. It makes no sense for low income people until they start getting CPP and OAS, because that's when the deduction will actually work for you. So there it is, line 208 in the GIS form, RRSP deduction. It's there. It's still there. And should you save money in a TFSA? TFSAs are always a good way for low-income people to save. The interest you earn can't be taxed, just like an RRSP. You don't have to take it out until you want to. Is that true of an RRSP? No. RRSP turns the chariot turns into a pumpkin at age 71. And all of a sudden you have to take the money and you're forced into a schedule. But money in a TFSA can't be clawed back, and there's no schedule for taking it out. So you can prevent the RIF bear hug. When you turn 71, what happens to a TFSA? Nothing. When you turn 71, what happens to an RRSP? Your RRSP starts to be taxable at about 5%. I got 3.96 and 15%. That's just for the COVID year, the 2020 tax return. And you have to take out more and more and more and more and more until you turn 95, when you're taking out 20% per year. But the 2020 only, there was lower RIF takeouts, which is on this page. And of course, everybody can get these slides afterwards, so I'm not going to go through the numbers. So just before that, just remember that when you turn 71 and you're in low income, and maybe all your income is coming from a RIF because you didn't hear about this presentation until recently, and all your money was in RRSPs and RIFs, then you have a financial problem. You either have, a refrigerator doesn't work, a car doesn't work, it's worse, or maybe you have adult children who need money. When you take money out of a RIF and you take a big payment out, what happens? The government cashes in on you in the very year that you need the money the most. So the government cashes in big when you have a real financial obligation. If you have the money in a TFSA and you take it out for that financial thing, what happens? Nothing. So can you collect OAS if you leave Canada? You can collect any form of OAS benefits for 6 months, but it's complicated after that. And we have a 20-year rule for Canadians who have lived at least 20 years between your 18th and 65th birthday, or different rules for people who are in the lucky residents of those, come from those 59 countries that have agreements. But if, generally speaking, you need to have lived in Canada for 20 years between 18 and 65, you can take your OAS and your CPP with you. You cannot take your GIS. You must be resident in Canada, breathing Canadian air legally to get GIS. You can't take it with you. Only your OAS and CPP, and you got to live here at least 20 years to do it. So new agreements, we used to have 55 agreements, but the newest ones are Serbia, Brazil, Bulgaria, and Peru. Very limited agreements with India and China that unfortunately don't have any OAS advantage, because neither India or China will pay you a pension if you move there. So that's the issue there. So 6 top tips: file your taxes unless you're in the Panama Papers, then you need a lawyer. Apply for early CPP if you're not on social assistance. Apply for OAS a year before you turn 65. Don't tick the box on the GIS application. Take out RRSPs or subscribe for them between ages 65 and 71 if you need to reduce your taxable income to the point where that you would be GIS eligible, and save in a tax-free savings account ahead. Why didn't you get this advice from the bank? Because the bank doesn't make much money off poor people, so they don't invest in giving them good advice until the course that Alexandra is going to talk to you about, because she has a course for financial planners. Many people don't like income support programs like GIS, don't want to talk about them, yet it's 31% of Canadian seniors collect GIS. You'll hear a lot about the OAS clawback, but it only applies to 3% of Canadians. Hardly ever hear about the GIS clawback, but it applies to 10 times more Canadians than the OAS clawback. So how do we spread the word? tell provincial and federal governments to give better information, push your financial institutions to train their staff to give good advice, and teach social agencies about the tax rules and income supports that affects low-income people. There's the URL, which I think is probably in the chat also. So I am going to do something called stop sharing, and hopefully that might get rid of it.
Oh, dear.
Sorry, I went a bit over. Here comes Alexandra. So has there been a lot of things in the chat?
Tons. Can you hear me?
Yes, I
Yes.
can hear you. There's a bit
Perfect.
of noise.
And there's a lot of noise that's probably me. I want to invite Alexandra to talk about the course that you've developed. And just, I want everyone to know, it keeps coming up through the chat. Yes, I'm going to share every bit of information that was here tonight. The slides will be available. The PowerPoint, the presentation will go on to YouTube. But in the meantime, by going in with the same link that you used to join tonight, you can watch a replay. Lots of information. The booklet that you see below you, Planning for Retirement on a Low Income, I'll include that in the follow-up, but it's also there as a link. And perhaps now if I can just invite Alexander, who must be totally exhausted. John, this was really amazing. There were so many questions, and boy, I commend both of you so much. Anyway, Alexander, can I invite you just to talk a little bit about that course? And that, of course, will obviously be shared in follow-up as well.
Yes, thank you so much. So in listening to John's presentation, you have an overview of all the concepts that you need, but sometimes people learn really well by applying the concepts. So based on John's material, and with the support of the Business Career College, which is an online college for financial advisors who are getting certified as financial advisors, as life insurance advisors, as certified financial planners, I developed a course, and now it's designed for financial planners to be able to provide information about retiring on a low income. All of the material that you've looked at or that you've heard John speaking about tonight, but it's available for anybody. It's totally free. Laura is going to send out information to everybody who's registered in this program, and that information will include information on how to register for and participate in this course. It's an online course. If you're, in this chat or you're attending this presentation, you have everything you need from a technology standpoint in order to participate in the course. There's so many questions still piling up in chat.
Yeah, and I'm hoping we can save the chat and be able to look at it later. And I know we have a number of financial advisors on the line. I also wanted to give a shout out to Bernard Dussault, who is the person in Ottawa who conducts these for the library system there en français. So for those who want to hear it in Canada's other language, Bernard, we're lucky to have Bernard who does that in Ottawa, and it's done through the Council of Aging in Ottawa. So those who are French speakers who wanted to look at, and especially people who have got money from QPP and CPP and have questions about that, Bernard's a real expert in that. And so it's the Council of Aging in Ottawa, and they put on the low-income retirement section en français. I'm going to
answer one question that's come up in the chat, which is about whether this course offers certification. So if you are a financial advisor and you need continuing education credits from FP Canada, if you're a CFP or a QAFP, or you're a life insurance advisor, or you are an IROC registered financial advisor, yes, all of those continuing education credits count for this course. And if you go to and you're going to get the link tonight, And if you go to that link, you'll see that you get continuing education courses. There's no certification in being an advisor who works with low-income people, but you do get these CE credits.
There's been a few questions about what about middle income Canadians. We know that there's a ton of advice for high income Canadians. That's the whole financial industry gives that advice, so we don't need to get into that. But for middle income Canadians, it's a good question, but we'd have to decide what middle income is, because it would be so important for, I think it would be more complicated actually to do something like this for middle income.
Well, the thing about doing work on low income is that we've got this definition. We've said, if you're eligible for GIS, that's low income. So we're not in a discussion about what is the poverty line and are we measuring it this way or that way and what's true low income. So we have this kind of external definition that we can point to. For middle income and high income, there's nothing like that, right? We could say, well, maybe you're middle income as long as you're not subject to the OAS clawback, which is not the GIS clawback. That's the clawback that starts at about $80,000 of income for a single individual. But then if the moment I say that, people are going to say, no, that's actually high income, or no, that's not, that's still low income. And there's no agreement.
It's one question asking what percentage of seniors have an income below the poverty line. Generally speaking, it's depends on which poverty line you use, but if you use the LIM, which is a low income measure, which is half the median income in Canada, you'd be looking at about somewhere between 6 and 10%. The reason it's so variable is poverty lines tend to get interested in the value of your housing. And if you're a low income senior and you own your own home and you're not paying any mortgage, they don't like to see you as being a person living in poverty if you have no shelter costs. So, but generally speaking, 6 to 10%. But the amount of people on GIS, a lot of people on GIS are not living in poverty. Some are, but some aren't. And there's your 31% figure of people who are receiving GIS.
Okay, I'm going to unmute now because I think all of the questions have been answered that have been posed. And I would really like to take this opportunity to thank both of you, John and Alexandra, for an amazing, truly amazing job tonight. And I can't tell you how impactful this program is for so many people across Toronto Public Library and obviously across the province, across Canada. Just absolutely excellent. And I can't imagine that you both won't fall asleep very shortly because it was really quite a Herculean task that you both presented and responded so well. And I'm seeing all kinds of thanks in the chat, and boy, oh boy, I will do my bit to follow up with everyone. That certainly kept coming up, and I will follow up with that for certain. I hope we can look forward to more sessions, continuing to offer sessions with John, Alexandra. I invite everyone to have a look at that Toronto Public Library website because we offer a fair bit of financial literacy programming for all groups, actually. So I'm going to, again, thank you both so much. Alexandra is actually going to be with us again next week. We have a slightly different focus next week with the basic total change in how personal finance seems to be working these days. So have a look at that. I'll include that with the info that goes out as well. Thank you to our audience. This has been simply amazing. This is a huge, huge turnout. And, obviously that just demonstrates the need for this type of information session even more. So thank you to all of you. And now I'm going to wish everyone a great evening. And I hope you both get to relax a bit at this point, and we'll talk soon. Good
Thank
night,
you.
everyone.
Yeah, thanks very much. Thanks very much to all and all of you who attended.